I want you to imagine two people. They sit across from the same banker on the same day, and they both sign for the exact same loan. Same amount, same interest rate, same repayment schedule. They shake hands, walk out the door, and their financial lives go in completely opposite directions. One of them, 5 years later, is still paying it down, relieved every time the balance drops, counting the months until it's gone. The other one? They used it to build something that now earns them more than their salary. Same loan, same bank, same day, opposite outcomes. So what actually happened? Here's what most people get wrong about debt. They think the question is whether to borrow. The rich figured out a long time ago that the question is how to use what you borrow. Debt, at its core, is a tool. And like any tool, it doesn't care who holds it. A scalpel in a surgeon's hands saves a life. The same blade in the wrong hands does something very different. Over the next 20 minutes, I'm going to show you exactly 6 ways that wealthy individuals and institutions use debt not to dig holes, but to build ladders. Some of these you can start today. Some require serious capital first. I'll be straight with you about which is which. But here's what I promise. By the end of this, you will never look at a loan the same way again. Let's start at the foundation, because before we can talk about the 6 strategies, we need to get one concept locked in, one that changes everything. The core concept, productive versus consumptive debt. Not all debt is equal. This sounds obvious until you see how few people actually act on it. There are 2 kinds of debt in the world: consumptive debt and productive debt. Consumptive debt is borrowing to spend. You buy a car that depreciates, a vacation that ends, a purchase that loses value the moment you make it. The money leaves, something temporary arrives, and you're left paying for a memory. Productive debt is borrowing to deploy. The money goes to work, it buys an asset, funds a business, creates cash flow, or earns a return. And here's the key. If that return is higher than what you're paying to borrow, you are profiting on someone else's money. That gap, the difference between what borrowed money earns and what it costs, is the engine underneath every single strategy we're about to cover. The wealthy didn't build empires by avoiding debt. They built them by mastering this one distinction. Keep that distinction in your head. Every one of the 6 strategies is just a different application of the same principle. Let's start with the one that's been running the global economy for centuries. Strategy 1. Trade credit. The invisible bank. Most people think you need money to make money. The first strategy is proof that isn't true. It's called trade credit, and it's how a significant portion of global commerce actually works. Invisible to most consumers, but completely standard among businesses. Here's the concept. When you buy inventory or raw materials from a supplier, you don't always have to pay immediately. Suppliers, especially manufacturers, will commonly offer terms net 30, net 60, or net 90, which means take the goods now, pay us in 30, 60, or 90 days. Why would a supplier do this? Because it's how they compete for your business. Credit is a sales tool for them. And for the buyer, for the business owner who understands what they're holding, it's a free loan. Think about the mechanics. You receive $50,000 worth of product today. You sell it over the next 3 weeks. The revenue hits your account, and you don't owe the supplier until the end of the month. You've just used their capital to generate your sales, and you paid them back with proceeds from the transaction they helped fund. What did it cost you? In many cases, nothing. zero interest, just the discipline to pay on time. Now scale this up. Smart operators negotiate longer terms and shorter collection cycles, meaning they get paid by customers faster than they have to pay suppliers. That gap creates what's called a float, money sitting in your account that technically belongs to the supply chain, but is yours to use in the interim. Apple, famously, has operated with a negative cash conversion cycle for years. They collect from retailers before they pay their manufacturers. They are, in effect, running their entire global supply chain on the world's largest trade credit float. You don't need to be Apple to use this. Anyone who takes a customer deposit before buying materials, anyone who uses a 0% interest card to float a 30-day purchase, anyone who negotiates payment terms with a vendor, you're using the same mechanism. The principle scales both down to a freelancer and up to a Fortune 500. Strategy 2. Real estate leverage. The math most people miss real estate has created more millionaires than almost any other asset class. But most people explaining why get the math wrong. So let's actually run it. You find a distressed property selling for $400,000 in a market where comparable renovated homes sell for $600,000. Nobody wants it because it needs work, which is exactly why it's interesting. You put 20% down, $80,000. You borrow the remaining $320,000 through a conventional mortgage. Then you spend $60,000 on renovation. At this point, you have $140,000 of your own money in the deal. The renovated property is now worth $600,000. Here's where the strategy gets sophisticated. Instead of selling and triggering a taxable gain, you refinance. You go back to a lender and pull a new loan at 75% of the property's new appraised value. 75% of $600,000 is $450,000. You pay off your original $320,000 mortgage and walk away with $130,000 in cash. You put in $140,000. You pulled out $130,000. You're essentially whole, with a cash-producing rental property you still own outright. Now run the returns. If that property rents for $3,000 a month and your new mortgage payment is $2,400, you're generating $600 a month in cash flow on a deal where almost none of your original capital is still locked in. This strategy has a name in real estate circles: BRRRR. Buy, renovate, rent, refinance, repeat. And the repeat part is what makes it genuinely powerful. Every time you complete a cycle, you potentially recover your down payment and use it to start another one. But, and this is important, the whole machine depends on one thing: finding a property that actually cash flows after the refinance. That's the discipline. That's what separates an investor from someone who got lucky on a hot market. The renovation cost, the refinance closing costs, the carrying cost during renovation, the vacancy risk. These are all real. None of them show up in the highlight reel. All of them show up in your bank account. This one is genuinely accessible to many people. Not everyone. You need real capital, a real credit score, and the ability to manage a renovation without losing your mind. But it's not billionaire territory. It's disciplined operator territory. Strategy 3. The buy, borrow, die machine. This is the strategy that gets whispered about in the financial press every time a billionaire's tax return leaks, and the number is somehow lower than a teacher's. It has 3 steps, and each one is completely legal, completely documented, and completely inaccessible to most people, at least at the scale they use it. But I'm going to show you the real mechanics anyway, because the small version of this strategy is something you can actually use. Step 1. Buy assets that appreciate. Stock in a company, a business, real estate. You hold them, they grow. And here's the critical detail. Growth in an asset's value is not a taxable event. You only pay capital gains tax when you sell. So the first rule of this game is don't sell. But you still need money to live, to invest in other things, to fund your lifestyle. If you can't sell without triggering a massive tax bill, what do? Step 2. Borrow against your assets instead of selling them. This is a real financial product called a securities-backed line of credit, or sometimes a portfolio loan. You pledge your investments as collateral, the bank gives you cash, and your assets keep growing untouched. The interest rate on these loans, currently somewhere between 5% and 7% depending on portfolio size and asset type, is lower than the historical average return of the market, which means you're borrowing at a rate below what your collateral is earning. You're living on cheap debt while your assets compound. And because you never sold anything, you never paid capital gains tax. Step 3, and this is the cold one, die. Under current U.S. tax law, when assets are inherited, their cost basis steps up to the current market value. The lifetime of unrealized gains, the growth that was never taxed, is simply erased. Your heirs inherit the asset at today's price. The loan gets paid off by the estate, and the appreciation your portfolio built over decades vanishes from the taxable ledger as if it never existed. The estate tax exemption in 2026 sits at $15 million per individual, $30 million for a married couple, which means for virtually everyone using the strategy, even that last step is clean. Now, I'm going to be direct. The full version of the strategy requires a portfolio large enough that a bank will extend you a line of credit against it. That's not something you build overnight, but the underlying principle, borrowing at a low cost instead of selling an appreciated asset and paying tax at a high cost, is something investors at every level should understand. Because it shapes decisions about when to sell, when to hold, and how to think about the after-tax math on every investment. Strategy 4. Business debt as a growth accelerant. This one is talked about the least and used the most by every serious business that ever scaled beyond its owner's personal savings. The concept is simple. When a business has a clear, measurable return on invested capital, borrowing to expand is not risky. It's rational. Let's say you run a service business. You've identified that every $10,000 in equipment you add generates $18,000 in annual revenue and $6,000 in net profit. Your return on that capital is 60% per year. If a bank will lend you $50,000 at 8% interest, and your return on deployment is 60%, you are pocketing the 52-point spread on borrowed money. Every Fortune 500 company in the world does this. They issue bonds, draw on credit facilities, and borrow from capital markets, not because they can't fund growth from cash flow, but because borrowing is cheaper than equity and the leverage amplifies returns for shareholders. The question isn't whether to use debt for business growth. The question is whether your unit economics actually support it. If the return on the capital deployed is higher than the cost of borrowing it, the math is on your side. If it isn't, if you're borrowing on faith rather than evidence, you've just given yourself a very expensive problem. This is accessible today for anyone who runs a business with provable, repeatable margins. An SBA loan, a business line of credit, equipment financing. The vehicle changes. The principle doesn't. Strategy 5. The 0% arbitrage, the small person's float. Everything we've covered so far involves large assets, real estate, business capital, investment portfolios. This one is different. This one you can execute this week with what you already have. It's called a balance transfer arbitrage, and it's the closest thing a regular person has to the trade credit float we discussed at the start. Here's how it works. Credit card companies compete aggressively for your business. As part of that competition, they routinely offer promotional periods of 0% interest, typically 18 to 21 months, sometimes longer, on balances transferred from other cards. There's usually a one-time transfer fee, 3% to 5% of the amount moved. That's the entire cost structure. You're renting a chunk of money for roughly 3 to 5% for nearly 2 years. Now run the math. If you're currently carrying a balance at a 22% or 24% interest rate, and you move it to a 0% card, paying a 3% fee once, you've just gone from paying $2,200 a year in interest to paying $300 total for the entire promotional window. That's not an investment return. That's a guaranteed saving. And guaranteed savings are often better than speculative investments because there's no risk variable. You cannot not earn the savings once you've locked in the lower rate. The discipline required, you have to pay it off before the promotional period ends. Because when the 0% window closes, whatever balance remains typically reverts to a rate that's as high or higher than where you started. But used correctly, not to buy more things, but to restructure existing expensive debt. This is the same arbitrage mechanism the importer used with trade credit, the real estate investor used with refinancing, and the billionaire used with their securities-backed credit line. Borrow cheap. Deploy into something that earns or saves more. Keep the difference. The number changes. The logic doesn't. Strategy 6. Credit score as infrastructure. Every strategy we've covered today depends on one thing: access to debt at a favorable rate, and that access is controlled by a 3-digit number that most people treat as an afterthought. Your credit score is not a vanity metric. It is the price tag on every dollar you will ever borrow. The difference between a good credit score and an excellent one can be 1.5 to 2 percentage points on a mortgage rate. On a $400,000 loan over 30 years, that gap is worth more than $100,000 in interest payments. That's not a rounding error. That's a car. That's a child's college fund. That's a down payment on another property. The rich don't have access to a secret bank. They have access to cheaper money because they've made themselves low risk to lend to. And the cost of capital is the most direct lever on every one of the 6 strategies we just covered. Lower your borrowing cost by 1 point, and every investment you make with borrowed money becomes more profitable. Every business loan becomes cheaper. Every refinance works better. Here's what's important to understand. Your credit score is almost entirely within your control. Unlike picking stocks or timing markets, improving your credit is a deterministic process. Pay on time. Keep utilization low. Age your accounts. Don't open unnecessary new lines. There's no secret. There's no shortcut. But there is compounding. Because every point you gain today lowers the cost of every dollar you'll ever borrow for the rest of your life. This is the foundation. Build it before you need it, because the moment you need a loan is the worst possible time to discover you've been neglecting your score. Conclusion: the only question that matters. Let's bring all 6 of this together. Trade credit, using supplier terms to run inventory on someone else's capital. Real estate leverage, putting in a down payment, renovating, refinancing, and pulling your capital back out while keeping the asset. Buy, borrow, die. Never selling appreciated assets, borrowing against them instead, and passing them on with the tax burden legally erased. Business debt as a growth engine, deploying borrowed capital when your return on it exceeds its cost, which is just rational math. The 0% arbitrage, using promotional credit windows to restructure expensive debt or float short-term needs at nearly no cost. And credit score as infrastructure, treating your borrowing cost as the single most controllable variable in your entire financial life. Here's the thing all six have in common. None of them are about having more money. They're all about asking a different question. Most people look at a loan and ask, how quickly can I get rid of this? Wealthy individuals look at the same loan and ask, what can this earn, and does that exceed what it costs? That's it. That's the entire reframe. Debt that costs you 7% and earns you 14% is not a burden. It's a machine. Debt that costs you 22% and earns you nothing is not a loan. It's a slow drain. The type of debt doesn't make you rich or poor. The direction you point it does. Now, and this is important, none of this is an argument for reckless borrowing. Leverage multiplies outcomes in both directions. When the math works, it works beautifully. When it doesn't, it works brutally. The risk is real and it deserves respect, but so does the opportunity. And the opportunity is there for anyone willing to stop thinking about debt as something to eliminate as fast as possible, and start thinking about it as a tool that can work for you the same way it's been working for the wealthy for a very long time. The difference was never the loan. It was always the question. Call to action. If you're watching this and thinking about which of these six you could actually apply to your situation right now, start with the last two. Your credit score costs you nothing to improve, and it makes every other strategy more powerful. And if you're carrying high-interest debt, the 0% transfer is worth running the numbers on this week. Those are free moves. No capital required. Just clarity. If this changed the way you're thinking about debt, not as the enemy, but as a tool, that's exactly what this channel is here for. We break down the mechanics behind how money actually works, not how people wish it worked. Subscribe if you want more of that, and drop a comment below telling me which of the six surprised you most. I read every one of them. Next video, we're going to go even deeper on one of these strategies. The real estate leverage play, step by step, with real numbers from a real market. You won't want to miss it. See you then.